Imagine this. You're standing on a used car lot. The sun is hot. The dealer is smiling, and you've just spotted the car that feels perfect for you. The price tag looks doable, but then the dealer starts talking about loan terms, interest rates, down payments, and suddenly it feels like you're reading a foreign language. What if I told you that by the end of this video, you'll not only understand exactly how used car loans work, but you'll also know the smart moves to save hundreds or even thousands of dollars? And stick around, because later in this video, I'll reveal the single most common mistake that traps beginners into paying way more than they should. Number 1. What is a used car loan, really? A used car loan is simply money you borrow from a bank, credit union, or lender to buy a car that's not brand new. You agree to pay back the loan in monthly payments, which include the amount you borrowed plus interest. Think of it like borrowing a friend's bike. You use it, but when you give it back, you also bring them a little thank you gift for letting you borrow it. That gift is the interest. For example, if you borrow $10,000 for a used car at a 6% interest rate over 5 years, you're not just paying back the $10,000. You're paying back about $11,600 total. That extra $1,600 is the cost of borrowing. Number 2. Why used car loans are different from new car loans. Banks and lenders see used cars as riskier than new cars. A used car might break down sooner, lose value faster, or come with hidden issues. To protect themselves, lenders usually charge higher interest rates for used car loans compared to new ones. For example, in recent years, new car loan rates might average around 5%, while used car loan rates might be closer to 8%. That difference of 3% may sound small, but over thousands of dollars, it adds up. Number 3. The role of your credit score. Your credit score is like your financial reputation. Lenders look at it to decide how much they trust you to pay back. If you have excellent credit, you could qualify for a loan with a low interest rate, saving you big money. But if your credit is poor, lenders may still give you a loan, but at a much higher interest rate. For example, with a 700 credit score, you might get a loan at 6%. But with a 580 credit score, that same loan might be 14% or more. On a $10,000 car, that could mean paying thousands more in interest. Number 4. Down payments and why they matter. A down payment is the money you put up front before borrowing the rest. The more you put down, the less you have to borrow. If the car costs $12,000 and you put down $3,000, you only need a loan for $9,000. That instantly lowers your monthly payment and reduces the interest you'll pay over time. As a rule of thumb, putting down at least 10% is good, but 20% is even better. It's like putting in a head start in a marathon. You'll finish the race faster and with less effort. Number 5. Loan terms explained. Loan term means how long you'll be paying back the loan. Common terms are 36 months, 48 months, or 60 months. Some even go up to 72 or 84 months. Shorter terms usually mean higher monthly payments, but less interest overall. Longer terms give you smaller monthly payments, but cost more in interest. For example, a $9,000 loan at 6% for 3 years might be around $270 a month. But if you stretch it to 6 years, the payment drops to about $150. That feels easier, but you end up paying much more in total. Number 6. The hidden trap of interest rates. Here's where many people get caught. A dealer may say, "Don't worry, this loan is only $150 a month." But they won't mention that the loan is stretched out over 7 years at a high rate. In the long run, you could pay almost double what the car is worth. That's like buying a used couch for $500, but ending up paying $1,000 because you agreed to tiny payments for too long. This is why you should always look at the total cost of the loan, not just the monthly payment. Number 7. Where to get a used car loan. You don't have to accept the dealer's financing. In fact, many times the dealer's loan is not the best deal. You can get pre-approved at your bank or credit union before you even step on the lot. Pre-approval means the lender already promises to lend you a certain amount at a set rate. That way, when the dealer tries to sell you financing, you already know what's fair. For example, if your bank pre-approves you at 6%, but the dealer offers you 9%, you know the dealer is marking it up. You can either reject it or use it to negotiate a better deal. Number 8. The danger of negative equity. Negative equity happens when you owe more on the loan than the car is worth. Cars lose value quickly, especially used ones. For example, if you buy a car for $12,000, but after a year it's worth $9,000, and you still owe $11,000, you're stuck with negative equity. If the car breaks down or you try to trade it in, you'll still owe the lender more than the car is worth. This is why stretching your loan over too many years can be dangerous. The car's value drops faster than your loan balance. Number 9. Extra costs you need to know about. Your monthly payment is not the only cost. There's also insurance, taxes, registration, and sometimes extended warranties the dealer tries to sell you. For example, your loan might be $250 a month, but insurance adds another $120, registration adds $30, and suddenly your cheap car is costing $400 a month. Always budget for the full picture, not just the loan payment. Number 10. How to pay less. Overall, there are simple tricks to cut your total loan costs. One way is to pay a little extra each month. Even adding just $50 to your payment can shave months off your loan and save you hundreds in interest. Another way is to refinance later. If your credit improves, you can switch to a new loan with a lower rate. For example, if you start at 12% and later refinance to 6%, you could save thousands over the life of the loan. Number 11. The common beginner mistake. Here it is, the trap I promised earlier. Many beginners focus only on the monthly payment. They think, if I can afford $200 a month, I'm good. But dealers know this and stretch out the loan to fit the payment, while charging you way more in interest. It feels affordable now, but costs you thousands later. The real question you should ask is, what is the total amount I'll pay over the life of this loan? That one question can save you from falling into the biggest beginner trap in used car loans. Number 12. A quick example from real life. Let's say two friends, Alex and Jamie, each buy a used car worth $10,000. Alex takes a 6-year loan at 10% with a payment of about $185. Jamie takes a 3-year loan at 6% with a payment of about $300. At first, Alex feels smart because his payment is smaller, but after 6 years, Alex has paid over $13,000 total. Jamie, on the other hand, paid less than $11,000. Jamie finishes sooner and saves thousands, while Alex is still paying for an old car that's losing value. Number 13. Steps to take before getting a used car loan. Check your credit score first. This gives you a realistic picture of the rates you might qualify for. Save up for a down payment. Even a few thousand upfront can make a big difference. Get pre-approved by your bank or credit union. This gives you power when negotiating. And know your budget. Don't just look at what you can afford monthly. Look at the total loan cost, plus insurance and other expenses. Number 14. Know the difference between simple and compound interest. Most auto loans use simple interest, which means interest is calculated on the amount you still owe, not on top of the interest you already paid. But if you're late with payments, some lenders may add fees or penalties that feel a lot like compound interest. For example, if your monthly payment is $250 and you're late, you might owe an extra $30 in fees, and those fees can snowball quickly. This is why it's important to understand how your loan calculates interest and what happens if you miss a payment. Number 15. Check for prepayment penalties. Some lenders charge a fee if you pay off your loan early. That means, even if you're being responsible and want to save on interest, they still want their profit. For example, if you try to pay off a $9,000 loan in 2 years instead of 5, you might get hit with a $200 penalty. Always ask if there's a prepayment penalty before you sign. Number 16. Watch out for add-ons in the loan contract. Dealers often try to sneak in extras like extended warranties, gap insurance, or service contracts. These can inflate your loan by hundreds or even thousands of dollars. Imagine agreeing to a $10,000 loan, but after all the add-ons, you're suddenly financing $12,500 without realizing it. Take your time to read the paperwork carefully and remove anything you don't truly need. Number 17. Understand gap insurance. Gap insurance covers the difference between what you owe and what the car is worth if your car gets totaled or stolen. This can be useful if you made a small down payment or financed for a long time. For example, if your car is worth $8,000 but you still owe $10,000, regular insurance only pays the $8,000. Without gap coverage, you're stuck paying the extra $2,000 yourself. Sometimes it's smart to buy gap insurance, but not always from the dealer since they often charge more. Number 18. Always compare the APR, not just the interest rate. The APR, or annual percentage rate, includes both the interest rate and any fees the lender charges. Two loans may look the same at first glance, but one could have hidden fees that make it more expensive. For example, a 7% interest rate loan with no fees could be cheaper than a 6.5% loan with a $500 origination fee. That's why APR gives you the true cost of borrowing. Number 19. Consider shorter-term ownership. Some people think they'll drive the same car for 8 years, so they take out a 7-year loan. But life happens. Maybe the car needs expensive repairs in 4 years, or maybe your lifestyle changes. If you still owe money when you're ready to move on, you're stuck. It's safer to choose a loan term that matches how long you realistically expect to keep the car. Number 20. Know your debt-to-income ratio. Lenders look at how much debt you have compared to your income. If your debt payments are more than about 40% of your income, lenders might either deny you or charge a higher rate. For example, if you make $3,000 a month and your debts already take $1,200, adding a $300 car payment could put you over the limit. Understanding this ratio helps you see what lenders see before you even apply. Number 21. Shop around for lenders. Don't just accept the first loan offer you get. Rates can vary widely between banks, credit unions, and online lenders. For example, one lender might offer you 9%, while another offers 6% for the exact same loan. A difference like that could save you thousands of dollars just for spending a few hours shopping around. Number 22. Beware of buy here, pay here dealers. These dealers finance the car themselves, often targeting people with bad credit. It sounds convenient, but they usually charge sky-high interest rates, sometimes 20% or more. For example, a $7,000 car could end up costing you over $12,000 when it's all said and done. Unless you have no other choice, avoid this route. Number 23. Look into cosigners if your credit is weak. A cosigner with good credit can help you qualify for a better loan rate. For example, if your credit score is 580, you might only get offers at 15%. But with a parent or close friend cosigning, you could drop to 7%. But remember, if you miss payments, it hurts their credit too. So only ask someone you trust, and only if you're confident you can pay. Number 24. Factor in car age and mileage. Lenders may have restrictions on the cars they'll finance. For example, some won't give loans for cars older than 10 years or with more than 120,000 miles. That's because older, high-mileage cars are riskier. If you're eyeing a really old car, you might need to pay cash instead of financing. Number 25. Know the difference between secured and unsecured auto loans. Most auto loans are secured, meaning the car itself is collateral. If you don't pay, the lender can repossess the car. Unsecured loans don't use the car as collateral, but they're much harder to qualify for and often come with higher interest rates. For beginners, it's almost always a secured loan. But it's good to know the difference so you're not surprised later. So, there you have it. Used car loans aren't as complicated as they sound. Once you know the rules, you've learned what they are, how they work, what mistakes to avoid, and how to save money. But let me leave you with this question. If you had to choose, would you rather take a longer loan with lower monthly payments but pay more in total, or a shorter loan with higher monthly payments but save money overall? I'd love to hear your thoughts in the comments.